Hello everyone, welcome back to another episode of Financial Tidbits with me, Royston, here at NAOF. Today we will talk about how you can generate risk-free income with this asset type called Special Purpose Acquisition Company, or SPACs for short. SPACs were the talk of the town back in 2020 and early 2021, where demand for these investment assets can be classified as red hot. In the first quarter of 2021 alone, there were 277 SPACs IPOs, more than the 228 IPOs announced for the entire 2020. At least, the SPAC market came to a screeching halt in April, likely the result of heightened regulatory scrutiny, with the SEC on 31st March issuing a statement that expressed concerns over the reporting, accounting, and governance of SPACs. Make no mistakes, the damage is real. The Defiance NextGen SPAC Derived Exchange Traded Fund with the ticker SPAK, which holds more than 200 SPACs, is down more than 30% from its recent high. There is no doubt that interests have substantially tapered for SPACs, but every blow up brings opportunity, and this one is no different. For this video, I will be focusing on just one particular pre-deal SPAC, one which I believe allows investors to potentially generate a risk-free 10% return on an annualized basis. This strategy might not be everyone's cup of tea, as it involves the usage of options. To be more precise, selling put options on a particular SPAC counter to generate income on a risk-free basis. That SPAC in mind goes by the ticker of IPOF. This is the Social Capital Hedosophia Holdings 6, which is sponsored by now notorious SPAC promoter Chamath Palihapitiya, who has successfully closed a number of high-profile SPACs back in 2020. IPOF is a pre-deal SPAC, meaning that it is still searching for an existing business entity to merge with. For pre-deal SPACs, a unique feature is that it has implicit price support at the $10 per share level. Its share price has been hovering at that level of late. Investors who purchase IPOF at $10 per share is unlikely to see much or any capital risk. This is because $10 per share is fully backed by cold hard cash kept in the trust. This cash is to be used only when the SPAC has merged with an operating entity. Prior to making any deals, the cash is theoretically kept safe in a trust, generating interest along the way. Hence, the price of IPOF is unlikely to fall below $10 per share for a prolonged period of time. It might dip below $10 per share briefly due to current market volatility, but likely to recover above that level when the market stabilizes. Therefore, investors getting in at $10 per share will likely see very marginal risk on their capital. None in fact. They can sit pre and wait for the SPAC to formalize a deal by which the share price would most likely appreciate. So what about the 10% risk-free annualized return that I highlighted earlier? Now, one can purchase IPOF at its current share price, slightly above $10 per share, and wait for a deal to happen and potentially see a price appreciation from the announcement of the deal. But there is no guarantee that number one, any deal is going to happen anytime soon, and number two, the deal is going to result in any price appreciation. Another way to potentially trade this counter with an income angle is to sell a put option on IPOF with a strike price of $10 per share. Selling a put option obligates the seller, which is you in this case, to purchase the stock if the price drops below the strike price, which is $10 per share. However, I've earlier highlighted that the price of IPOF is unlikely to drop below $10 per share for a prolonged period due to the fact that 100% of the share price is backed by cash before a deal is actually completed. Hence, selling a put option with a $10 strike price is relatively risk-free in my opinion. A put seller can earn approximately $18 based on a cash capital outlay of $1,000 or one option contract, for a duration of roughly about 59 days, generating an annualized return of more than 10% on this trade. This can be done as long as IPOF has yet to formalize any deal, which I will talk more on that later. The capital generated from the option selling exercise can also be used to purchase longer dated call options to ride on any potential price upside for an announced deal. Now, this is a situation that is unique pretty much to IPOF. While there are hundreds of pre-deal SPACs around, this is the only counter that one can trade using options with sufficient liquidity. Coming back to IPOF making a deal announcement, Bloomberg recently ran a report that IPOF could be looking to merge with luxury gym operator Equinox Holdings. This is still very much hearsay and there's no confirmed announcement made by IPOF. Until the deal is formalized and completed, the $10 per share support level will remain and an option seller has the opportunity to capitalize on a put selling trade on IPOF as highlighted above. I hope that you have enjoyed this financial tidbits on generating a risk-free 10% annualized return on trading IPOF options. Note again that this situation is unique to IPOF, likely the only SPAC that has sufficient liquidity in its options chain for such a strategy. If you like this video, I appreciate it if you smash the like button and share this financial information with your friends. Once again, this is Royston signing out.